Hello, my friends. Paul here, and welcome to WESPN. And of course, I'm here with my good friend Scott Innocente. And Scott, today we've got the Bank of Canada holding the rates. We've got Q1 is in the books, so we're going to do a little Q1 stats breakdown. And question: could the rates go up again? And a $300 million investment that could lead to 1,100 jobs in Windsor announced last week. So lots to cover on this episode. First things first, I just got back from Pinehurst. And if you're into golf and you want a good golf trip, I can't recommend enough Pinehurst.
Where is Pinehurst here?
Pinehurst is in North Carolina. Beautiful town. The boys were buzzing out there. We played some awesome courses. Played Pinehurst number 2, where the U.S. Open was last year, and just a special golf place. We had a nice time.
You had a great quote earlier. You can tell the quality of the place you're staying by
the actual hotel that we stayed at. You could tell the quality of the hotel by how many times you touch the door handle on the entrance.
I was a little bit confused by that. I thought you were saying you didn't want to touch the door handles. But
no,
what it actually means is
service, 5-star.
Service.
You walk up, you introduce yourself to the front. The door just opens automatically. Someone's there just opening it. I don't get it. They just know when you're coming, and pretty special place.
Well,
great.
Now that you're done bragging,
So, yeah.
we can maybe jump right to the
straight to real estate. Straight to real estate. So.
Yeah.
This is we're Wednesday today. We just had the announcement from the Bank of Canada for the interest rates, and Scotty, they held.
Yeah, it's a little bit of a surprise to me because, as we know, Canada's economy is not exactly roaring right now. Coming off a lost decade with close to zero GDP growth over a decade, that's pretty insane. And that basically just means that our economy's been stagnant and the country is not getting richer. Even though GDP was growing, the population was growing as well. Which means that as the growth is being spread across more people, which is basically leaving us flat. So our economy is stagnant. The tariffs aren't helping. Why did they decide to keep rates steady instead of cutting and hopefully boosting the economy? And I think the big fear there is inflation, right?
Yeah.
The tariffs are theoretically inflationary, and now the Bank of Canada is really caught between a rock and a hard place. Do you cut rates and stimulate the economy, risking inflation? Do you hold steady? Do you raise them?
Tough spot.
Very tough
Now,
spot.
I mean, I guess we'll jump to segment 3 here because you mentioned it. Now, is there a risk that interest rates could actually go up? We're on this trajectory of them going down for quite some time now, with these tariffs and everything that's going on. Obviously, we're in an election month at this point. Is there a chance that interest rates could go up?
There's definitely a chance. I think the Bank of Canada has outlined 2 scenarios. Number one is a relatively quick relief on these tariff threats. Everything gets worked out. Trade opens back up and the threats diminish. They would anticipate in that situation kind of a slowing economy as Canada starts to roar back up probably for about 6 months and then stabilize inflation, then probably heading towards lower rates again. And the second scenario that they ran was tariffs don't come off. They are prolonged. Inflation starts to tick higher, possibly even towards 3.5% inflation. If that scenario plays out, then we might see rates tick higher.
Yeah.
And that is troubling, as we know, for a slowing economy, and it's also not great for the real estate market if that happens.
Now, explain a little bit the relation between tariffs and inflation going up.
Global trade theoretically reduces the cost of goods and services worldwide. If tariffs get slapped on, it's kind of a catch-22, right? We export a lot of stuff, like let's say lumber, for instance, steel, aluminum. Well, now we'd have a glut of extra supply here for maybe a few items because they're not being shipped abroad. But broadly speaking, most of the goods worldwide would probably rise in price. I saw a chip manufacturer today, because they're not able to export as freely anymore to all these countries, they actually raised prices by 30% to offset the lack of sales that they're going to get. So you're going to have to see companies and corporations adjust their pricing model to possibly lower volume. And the inflationary risk is real there. So now what's going to happen with the tariffs? Does the worst case scenario play out, or is this really like a big strategic bluffing game by the U.S.? A lot of people theorize that the U.S.'s actually biggest fear right now is refinancing close to $9 trillion of debt at much higher rates than when the debt was taken out. So every quarter point of interest rate cuts in the U.S. is like billions of dollars of savings. So The theory is that they might be trying to use fear, uncertainty, and doubt, which is, if you look in the news, it's changing every day. Nobody knows what's going on. Fear, uncertainty, and doubt gets people to stop spending. It gets businesses to stop investing. Inflation theoretically cools as the economy cools. You refinance the debt at a lower rate and maybe open things up. Now, that's just a theory, right? Nobody knows. But hopefully it's something like that and the trade war gets worked out not in the not too distant future. But if not, yeah, we've got some troubling times ahead for sure.
Yeah, and in the real estate market, I mean, with the news cycle, our real estate market is heavily dependent on the news cycle. It definitely affects it. I think there's for sure fear in the market right now. And I find when fear sets into the market, people just kind of stop, right? They don't go out for dinner. They don't sell. They don't buy. They don't do much extra because there's too much uncertainty.
Well, what are the three responses to fear or troubling situation? Freeze, flee, or fight.
Yep.
And I think right now, nobody knows what to do, so they're just freezing.
Yep.
And you don't make big economic decisions. Your job might be on the line if you're in the automotive sector. You're not really sure how that's going to play out. Hey, I'm not doing anything right now. We're just completely on pause. We're pausing vacations. We're not moving. We're just going to stay put for now. So we're seeing a lot of that, and that's, I think, reflected in a lot of the data that we're seeing as well.
Yeah, and I think people are definitely not going to the States as much. The dollar affects that, and the relationship and how it's played out. People are definitely staying closer to home and reconsidering those trips for sure. Now, the data on our end, so this is end of Q1 data here. So, and we're going to compare it to last year. So listings, year to date, we've got 2,592 listings that have hit the market compared to 2,163 last year. So listings are up almost 20%. After Q1, sales are down 13%, right? Which is
listings up, sales down.
Listings up, so inventory's high, sales are lower. But what's really interesting here is that the average sale price has risen almost 2% compared to last year. So what does that tell us? It tells us that houses are still selling. Not every house is selling, of course, but the ones that are selling for a good price. Now, when I look at the numbers here, it becomes very confusing even to me because we're in the trenches, we're in the market every day, and it feels like a healthy market.
Yeah, it's really a confusing market. It's a confluence of competing factors here. We've got lower rates, we've got low supply, we've got a growing population, but we have fear, uncertainty, and doubt, and we have economic shock and relatively high inflation. So all these forces are competing with each other, which makes it a confusing market. Yeah. There are a lot of people out there that have solid jobs. They have money. They're not really affected by this, and maybe they're the ones that are making the most economic decisions. And we're finding the highest quality properties in the best locations are getting multiple offers. Like we're talking 7, 8, 9, 15, sometimes even more offers. And then you have other properties on the market just languishing. Yeah. And typically those are a combination of three factors, maybe not the highest quality property, not the best location, or overpriced. Right, they want 2022 prices. We're not in 2022, and they're just unwilling to sell. So, confluence of factors, very confusing market. I've got some confused clients right now.
Yeah, and I think equity plays a role into all of this. I mean, if you bought something in 2021, 22, 23, you're playing off your delta and what you bought it for. You don't have much equity in the home because the market has come down since then. It's the ones that, have been in the homes for, 10 plus years, even 6+, where they understand the market. They know they bought it for X. They know they're going to sell it much higher for Y, and they'll play to that and they'll price it accordingly. Sometimes when we list properties, we're married to, what they bought it for, and we want them to make a profit, right? So we have to do our best job to try and accomplish that for them. But sometimes the market doesn't. Sometimes the market just doesn't care. Right?
Yeah, that's a great point there. It's hard.
The phones are buzzing though. The phones are still ringing.
Somebody has heard you. It's. I mean, let's say you bought something for $750 at the peak of the market in 2022, and now you see the neighbor just sold for $650. On paper, you're down $100,000. Nobody wants to take that loss. I don't blame them. At the same time, it's this weird thing because if the price of your house goes back up to 750, then so does your neighbors and so does the rest of the market. So you'd be kind of buying and selling in the same market is what mitigates your risk.
Yeah.
However, yeah, if you're not in an equity position, it can be pretty fearful to make the move, and might be a little bit more difficult to get approved for that mortgage again.
Yeah.
As well. So there's a lot of factors there, and I think that's a great way of putting it. If you're sitting on a few $100,000 of equity, it's much easier to make a move right now when the prices are lower, right? You got the equity there, prices are down.
Yeah,
Great time to move.
and I think location is definitely playing a factor here. Where your property sits is going to dictate the demand for it. Properties that are further out of the city, Tecumseh, LaSalle, they're going to sit there a little bit longer. I'm seeing. I'm also seeing when we talk about tariffs, and I think that's a hot button topic. Of course, I don't have much tariff conversation in the, let's call it, I'll go a little bit high, the 700 and under market. When I get into the market that's 700 and over, it's definitely a topic of discussion of why people aren't making that jump to actually write an offer on a property. They could come see it 2-3 times, answering all the questions, servicing them, and at the end of the day, they're like, you know what, there's just too much uncertainty right now. In that higher price range, I find that the fear sets in a little bit more, which kind of makes sense because the payments are more, the investment is more. They're just a little bit more cautious. Now, when I go to our lower price range and we still have a 350 to 600 market, very robust, very, very busy, multiple offers. We're seeing multiple offers in every price range. If your house is priced correctly or aggressively, the buyers are definitely out there. So
yeah, different price ranges are experiencing different scenarios there, and I think the 750 to $1 million range is kind of like the trade up range.
Yeah.
You're in a smaller house, you just had a couple kids, you need more space, you're trading up. But then the payments go up as well with this economic uncertainty. Yeah, people just a little bit more on pause.
I think we'll power through all of this uncertainty like we always do. Again, the stuff that I like to track are the units that are selling, and again, those are down 13% compared to last year, and the total sales volume, which is if you take the number of units that have sold and the actual prices of those homes, that's down about 10% through our whole market. So not good, but at the same time, how it feels out there and how the numbers look, it just feels a little bit different. Now, if this drags on and this tariff thing is a thing that's going to be long term, well, then we're going to see some job loss, and I think if we see job loss, that's when you're going to see a big dip in the market. So we'll see if we power through this, or if it actually has a long term effect and does result in job loss, then that's not good at all.
Yeah, couldn't agree more. And I think if you're on a variable rate right now and you're wondering what to do, I would be watching that inflation data. Every report, I'd be paying attention to it. If we start to see inflation ticking up again, like right now it's still ticking down or it's pretty stable, heading lower. And also the carbon tax cut is supposed to reduce inflation across all sectors in Canada by almost a full percent. So we do have some disinflationary forces as well. But watching inflation data, if you start to see it tick up and you're on a variable, it might be time to lock in.
What's inflation at right now?
In Canada, it's around 2.3%.
So you're saying that could potentially come back down to like a 1.5 and...
Yeah, if all else was equal, we'd be heading much lower. It's the uncertainty of tariffs and how that's going to impact our economy that we don't know the effects of yet, which would be inflationary. So we've got a lot of counterbalancing forces out there. But if I've got a variable rate mortgage myself, and I'm watching, okay, if that inflation starts to tick up like it did in 2022, 2023, you started to see inflation tick up and get out of control. That's your indication. Now's the time to lock in because they have to raise rates to combat the inflation. So we're not there yet. And we don't know how it's going to play out, but that'd be the indicator you're watching.
I think as a realtor, a lot of us learned quite a bit about interest rates these past few years. They were kind of always stayed around par for the course, and then obviously COVID happened, and they went really, really low, and then we got out of that, and then they started to go really, really high. I know personally, I learned so much about interest rates and inflation and how much that affects the market. So that tip to actually not watch the rate, but watch what that rate is based off of, like the inflation.
That's your
right?
data. Yeah,
I think that's getting ahead of the storm there. And yeah, sometimes you got to make decisions based on the information that you have, and that's a great tip to grab that information and make a solid decision.
Yep. So pay attention to that, and then I guess lastly to summarize here, I was driving on 42 the other day past the Windsor Airport. I look over and I see this big building being built. I said, "What the heck is that?" And I did a quick search on ChatGPT and found that it's the Mint Group building a massive fabrication plant there. $300 million investment, about $50 million of it covered by the Ontario Investment Fund, and going to create 1,100 new jobs in Windsor, direct jobs. It's an auto sector play. They're building battery housings and some other auto parts there as well. So there's still like so many positive economic drivers here in Windsor. If it wasn't for this uncertainty, I think we'd be really ripping. But massive investment. You can see it if you're down by the airport. You can see it under construction right now. So
such a weird time to have that announcement right in the midst of, where I think our concern is, you hear this news of Honda yesterday pulling out Canada operations and going to the States. How, whether true or not, I mean, I read some reports after that they are staying the course. They're just always looking to diversify or protect their investment based on the current global conditions. But I mean, right now, I think everybody's fear and uncertainty as well. Are these car companies going to completely pull out of Canada? And then in the midst of all that, you get this Mint announcement of a $300 million investment that could create 1,100 jobs. And then we'll see what happens with Stellantis as well. But I agree. If these tariffs and all of this fear wasn't set into the market, I think we'd be ripping right now pretty good.
We were gearing up pretty good there.
Again, Windsor kind of, I mean, this one's different because we're an auto town, but Windsor lately has ripped through and hasn't been as affected as these other markets like a Toronto market and stuff like that because I don't know, we're kind of insulated down here and it's nice.
I mean, the Toronto market, single family detached is still quite strong. It was plus 3% this past quarter. It's the overbuilt condos bought by investors and foreign money that are now sitting vacant. There's just an oversupply of them. So Windsor didn't have that. We didn't have condos being built at the time. Now we have apartments being built, but they're not condos and they're not for resale. So yeah, we've definitely been insulated by them, but now we're more impacted by the tariffs. So we'll see how it plays out.
Yeah, and I think monitoring that unemployment rate here is going to be huge. Again, for me, it all comes down to job loss, and if we can avoid or prolong that job loss, then we'll be okay.
I will note as well, over the 100-year history of Windsor's auto sector, the Canadian government's always, no matter what, stepped in to support the automotive sector. I would anticipate they would do the same thing here. There would be negative consequences to it, such as inflation, money printing, currency devaluation, all that stuff. Loss of Canadian purchasing power globally. I think our dollar would fall against the U.S., right? If they step in with billions of dollars of support to Ford, GM, Chrysler, Stellantis, battery plant, all that stuff. I still think they would do it, though. It's too risky to let it fail. So we'll see.
At the end of the day, we're 3-4 months down the road, or maybe even call it 6 months. Do you think this all shakes out and there's a agreement that works great for all sides? I'm not even going to say both sides because this is not an American Canadian thing. This is China. There's a lot of countries involved on this one. Do you think it shakes out and everybody finds common ground and moves forward positively?
I mean, historically speaking, the world always figures itself out. Yeah. So I would say yes.
Except for those couple wars, they just couldn't figure that.
Well, eventually it worked. It figured out, right?
That's right. Yeah. So I mean, obviously we're not going to get to that point, but it's a trade battle out there, and everybody's kind of jockeying for position. It sounds like the U.S. is really taking the reins on this one, and wants to hold the negotiation. I think it's all going to play out just fine, but what do I know?
It seems like it's been going on for so long, but it's really only been a couple months here. This stuff is global trade readjustment is going to take some time, and you got to hold your positions until it's figured out. So I'm not surprised nobody's like the U.S. isn't caving in right now because they probably have an end goal. We just don't know what it is yet. So hopefully, 6 months is enough time to get it resolved.
Yep. Now, if you need any other information or you need an opinion on anything real estate related in your world, always feel free to reach out to myself or Scott. And once again, thank you for watching this week's episode. Appreciate you.